Even with a potential debt ceiling deal in the works, the effects of the GOP's hostage-taking have already had an impact on the American economy. Yesterday afternoon, Fitch Ratings, one of the three major credit ratings agencies, put the U.S. government's AAA credit rating on negative watch. Wrote the agency in a statement, although Fitch continues to believe that the debt ceiling will be raised soon, the political brinksmanship and reduced financing flexibility could increase the risk of a U.S. default. Before the deal was announced today, interest rates on short-term Treasury bills spiked, driven by fears that the Treasury would not be able to pay if the country defaults in the next few months. At Reuters, Felix Salmon argues that the default has already begun. Right now, with the shutdown, we've already reached the point at which the government is breaking very important promises. Indeed, we promise to pay hundreds of thousands of government employees a certain amount on certain dates in return for their honest work. We have broken that promise. But with news of a deal brokered in the Senate, markets are responding. Joining us now is Economic Studies Senior Fellow at the Brookings Institution and columnist for Bloomberg View, Justin Wolfers, who is also a professor at the University of Michigan. Justin, thanks for joining us. We are sorry that you had to suffer through all those boring white guys speaking on the floor of the U.S. Senate.
Nothing's uninteresting as senators talking and pretending they like each other.
Well, that is definitely something they are doing. I want to ask you from the economic perspective. Yeah. What are the consequences here? I mean, it looks like we may have a deal. The markets are up. The Dow is up over 180 points. And yet, Felix Salmon says we have done irrevocable damage. The government has broken some fundamental promise to the American public and, to some degree, to the global community. What are your thoughts on all of this?
This isn't over. Basically, investors look at the United States, and we've got a system right now in which we can't, I think, convincingly commit that we'll always be paying our debts in the future. And so certainly bond yields are coming back down today, but everyone understands we're going to revisit this game again in February, and we're going to revisit it every few years, and we've got a system of perpetual gridlock. There is a real risk that one day, when you play chicken often enough, someone goes off the cliff. And if we keep playing, we're going to price that risk, and that's going to cost you and me.
One would think that, given that, the markets would have been sort of perhaps more forceful in their response earlier. I mean, right now the markets are rallying, and I think there was a lot of people were talking about a second game of brinksmanship between the markets and Wall Street and what was going on in Washington. We're not going to show you we're panicked because we don't really believe you guys are going to take us over the cliff. If this is now the norm, why didn't the markets sort of panic earlier and show Washington that they meant it?
Well, the markets didn't panic. It turns out they were right. It looks like we're going to get to a deal, right? And, you know, one of the reasons a deal didn't get done is they weren't sending a particularly strong signal of panic. But time and again, it does look like politicians keep telling us, trust us, we'll get it done on the last day. Every time one of these episodes come up, they say, this time's different. I was dumb enough to fall for it this time, and I got worried. But once again, you know, it all happens at the last hour, and somehow things have come together. So. And
yet you think the damage is serious and real in the long run because this has now been established as a pattern of behavior. What does that mean? Like, in terms of Treasury bonds, in terms of Chinese owning $1.3 trillion of our debt, does that make the international actors question whether they should be holding the dollar?
It makes anyone question whether they should be lending to us at low interest rates. It's as simple as when you apply for a mortgage. You apply for a mortgage, you've got a good credit history, you get a low interest rate, mortgage costs you less. If you've got a bad credit history or you've done a whole bunch of dumb things in the past, pretty much what Congress is insisting on doing in 2011 and again right now, it's going to cost you more. And so you're going to see, I think the US government is paying more on its debt today and in the future as a result of this sort of silly brinksmanship. And so, you know, it's kind of crazy. Republicans talk about taxes. This is basically a tax on all of us. It's costing us real money.
Micro question, actually, because, you know, we talk about the world markets, but the shutdown that preceded this default standoff also cost the economy a lot of money. The estimates are $300 million a day in lost business activity. What does having another deadline right after the holiday season mean for the U.S. economy with respect to just a government shutdown, not a debt default?
I mean, this is all about adding uncertainty. It's strange to see how the economic political narrative changes. 2 years ago, it was Republicans talking about the problems of adding uncertainty, but we now have enormous certainty. We think the government's going to continue operating for 2 more months, maybe 3 months.
Right, exactly.
3 months.
Things like fine. Till January 15th. Well, and it was a concession, right? Going from December to January.
And I mean, it's difficult to figure this out because we haven't got a lot of experience, actually, of government systematically going out to create uncertainty. But certainly, it is something that I think worries real economists, and we think can pull back a little bit on economic growth. And, you know, the recovery is still... Let's go back to talking about the economy. We were doing that 2 months ago.
Yeah.
And we were worried. The recovery was faltering. Unemployment wasn't coming down quick enough. And right now, we'll just hit it with yet another shock.
Yeah, and ironically, we don't even know what the jobs numbers are because the people that produced the jobs numbers report were furloughed. Kate, John Podesta was here, and he said he thought that this was an end to the question of the debt ceiling being used as leverage. He thinks that the Republicans have been shellacked enough, to borrow one of President Obama's favorite terms, that they won't go back to this well. What do you think?
I think if you speak to leadership aides, if you speak to, members sort of who are close to leadership, they would think the same thing. That the Tea Party caucus doesn't have the same kind of force moving forward. One would hope. But they've said that before, and you've seen where we've ended up again. I would also argue that there's a number of Republicans who don't actually believe that if we defaulted, anything really bad would have happened, and that still remains a problem for all of them.
And that to me is fairly shocking, right? I mean, and yet, to some degree, Justin, is part and parcel of a Republican Party that is increasingly reliant on its own sets of facts and data and numbers, right? It's a very, very worrisome trend that now we're talking about two parties that have different understandings of economics.
Yes, well, misunderstandings. I mean,
one of them has a misunderstanding.
Default denialists, it's a term I just would never have imagined a couple of years ago, and I would never have imagined it from the party that purports to speak for business. It is kind of astonishing, but it's not clear they mean it. If you think about it, it's actually a brilliant strategic move. Pretend you don't believe it's a problem. If you're playing chicken, you really want the other side to believe you're the one who's going to keep going, right? You're not going to blink. In denying it and pretending to believe it. So I have no idea if the so-called deniers actually believe it.
Well, but Frank, I think
it's based on a fundamental reading of human behavior. I mean, they were trying to ransom Barack Obama, and it was based on an assumption that the guy would fold based on past patterns of behavior. And now that Obama has shown that he won't fold, that he refuses to be ransomed, and that he was able to maintain a unified party behind him throughout, it's just hard to believe that even somebody with a very, very different, let's say, worldview would mistake the events that have just unfolded.
Well, I'm of two mindsets on this, because one was a telling thing that Heritage Action came out and the Koch brothers came out prior to the debt ceiling saying, we don't really care about the debt ceiling. Let's focus on the continuing resolution and fight that battle. So that might convince them. But then I have this vision in my head of John Boehner in 3 months' time saying, you got your clean debt limit increase 3 months ago. Now it's time to pay up. And so I can see this going one of two ways. I just don't know which way it's going to go.
Justin, before we let you go, business. Do you think there are, this is sort of a cascade effect, that in the future, in the midterms in a presidential election, business will be more skeptical of the party, that they will say behind closed doors, you guys cannot behave like that, we will not give you money, and we will not support candidates that are furthering this kind of line of, these lines of argument and this kind of policy?
I mean, one hopes, and it's really an indication of how far we've come, that liberals now are hoping that business plays a bigger role in disciplining the Republican
Why won't
Party.
they just listen to Wall Street? It's amazing. It's a truly fundamental shift. University of Michigan professor, the inimitable Justin Wolfers, thank you for your time. So we have a deal, and Ted Cruz says he will not block it. What comes next? We will get an update on the path forward from the lovely Luke Russert. That's next.